Is it time to sell these stocks? By these stocks, I mean the recovery stocks that have rocketed upwards in the past couple of months, the reopening plays like airlines, restaurants, etc. In this video, I don't want to tell you what to sell or what to do or what to buy. I just want to give you some perspective from a fundamental lens and also talk about some opportunities in some major tech stocks that some people might not be seeing. Let's do it. What's going on, everybody? My name is Matthew, and today we are talking all things recovery stocks. First, we need to set the scene. How far have these stocks run up? How fast? And why is all this happening? Then we'll dive into the fundamentals of American Airlines and Cheesecake Factory, two examples and their historical valuations. Then we'll look into some tech stocks that are starting to look really attractive, trading near pre-Rona levels, which is just crazy to see. All right, so around October, I'd say we started to see more life in these recovery stocks. Many began to start this recent leg up that we've seen. This outperformance has only become more apparent as the Dow and S&P continued to set all-time highs, while the Nasdaq entered a correction and growth has also suffered. This particular rally in value and recovery stocks gained traction a couple of months before the first shots would be administered outside trials in the US. In my opinion, the easy money in the recovery trade has already been made. Someone once told me, if you can hear the birds singing, spring has already sprung. Now, these stocks might still have some more momentum in them for the next few months, but let me share with you two stocks that I think cover the spectrum relatively well of some sketchier fundamental wise recovery plays and some better ones as well. So starting with what I would consider a relatively risky fundamental investment right now at its current price, American Airlines. American Airlines could continue to keep short-term momentum, and the rest of the airline stocks could do so as well. And American Airlines tends to have the biggest moves both up and down. But let's look at the fundamentals. The business of airlines is already cutthroat enough with its razor-thin profit margins. In fact, American Airlines requires the highest number of passengers of these four major airlines just to break even on a flight. Meaning if any plane is below 78.9% capacity for American Airlines, on average, they should lose money. Now, I'm sure they found cost efficiencies during the Rona, but let's also take a look at their financials. We see that their revenue decreased from about $10 to $11 billion per quarter in 2019 to just $3.4 billion in revenue in the fourth quarter of 2020 and less than that in the second and third quarter of this past year. Revenue is expected to rebound by nearly 50% to $26 billion in 2021 and then $37 billion in 2022, which is honestly a decent recovery speed. But keep in mind, those revenue numbers that I just shared with you only bring us to about 2013 and 2016 levels in terms of revenue. They managed to lose over $2 billion per quarter in net loss in 2020, and they also increased long-term debt on their balance sheet by nearly 50% from $20.8 billion to $29.3 billion. This has led to their interest expense increasing by over $100 million per quarter from Q4 2019 to Q4 2020. And that may not sound like a lot because we've been talking about billions, but again, keep in mind how razor thin their margins are. A $100 million reduction in net income from December 2019 would result in roughly a 25% decrease in net income. Now, I will give them this. They plan to borrow $7.5 billion to pay off one of their government term loans, effectively exchanging $7.5 billion on 12% interest for $7.5 billion on hopefully about 6 to 6.5% interest, if I'm understanding this correctly, and if all goes according to plan. This should help reduce their interest expense. But the fact remains they still have nearly $30 billion in long-term debt on their balance sheet, and with all of this in mind, American Airlines is currently trading at about a 2-year high in terms of its price-to-sales ratio.
What?
So yeah, American Airlines price-to-sales ratio has not been this high since March 2018, and I use price-to-sales because they did not have any earnings or EBITDA in 2020, so I can't use PE or EV to EBITDA, but their enterprise value has increased significantly because of the debt, so their EV to revenue is also pretty much near an all-time or recent high. And don't be fooled, American Airlines stock price is still down since February 2020, but its market cap is actually higher because they issued more shares in the past year. So despite a cheaper share price, you're actually paying more for this company than you were back in February 2020. So that's an example of a stock that absolutely flew during the recovery trade, but in terms of its fundamentals, I'm not really sure if it's justified. So let's take a look at the other end of the spectrum. And for that, I want to use the example of Cheesecake Factory. Now, I actually used to own this stock at about $22 per share and made several videos on this channel talking about it as the best stock to buy back then. But then I sold it around $37 per share or so. And of course, that was probably a mistake. I also made a video about when I did that, but I think it's good when we talk about our mistakes and what we can learn from them. So let's jump into some analysis for Cheesecake Factory. We'll keep this one quick. In the same year-over-year comparison, we can see their revenues have recovered incredibly well. This is largely because Cheesecake Factory has been able to adapt very well to the pickup and delivery business model, or what they call off-premise business. And while they're not yet profitable again, their interest expense has actually decreased in the past year. Coming out of lockdown has actually allowed Cheesecake Factory to double down on the area of their business model that they might not have otherwise emphasized, and that is of course off-premise dining, or what is more commonly known as delivery and pickup. This is a portion of their business that has helped them through this global situation, but will continue to thrive even after all this is over, in my opinion. Now, Cake has also been trading at roughly 2-year highs based on its price to sales ratio, but I would argue that it is much more valid compared to American Airlines because they added a strong arm to their business. They saw little to no change in debt on their balance sheet from Q4 2019 to 2020, and the business is relatively close to quarterly profitability, again, in my opinion. Now keep in mind, headlines are probably going to be filled with tons of good reopening news for the next few months or so. So again, all these stocks could continue their short to mid-term momentum. This was just to say that eventually, when fundamentals do take over again, there are some stocks that I would personally rather be in against other stocks. Alright, finally, let's talk about some opportunities that have been presented in some big tech names thanks to this recent sell-off and rotation. We've got Zoom kicking it off, trading at a price to sales of 36, which is usually high, but for this company in particular, it looks relatively reasonable considering its past performance and past historical valuations. This is actually pre-Rona levels for the company, and they were the poster child of work from home. This one's looking pretty attractive and pretty interesting after dropping 45% from recent highs. Alibaba is another name trading near pre-Rona levels and actually very close to March lows in terms of price to sales, but based on its PE ratio, it's trading more closer to mid-summer 2020 levels, and it's down roughly 24% from recent highs even after this 9% green day. I understand that there are headwinds with the CCP and headlines look quite scary right now, but our Discord mentors actually did a live exhibition of how this $2.8 billion fine affects Alibaba's fundamentals, and TLDR, it kind of looks like a short-term headwind and looks like the market agrees. At the end of the day, Baba is a cash cow and looks to be potentially undervalued. And lastly, I do want to talk about Amazon, trading at a PE literally lower than almost the March lows of 2020. I really just want to show you that sometimes there are opportunities in the stock market staring at us right in the face that are worth looking into. I think Amazon is somewhat undervalued here, but we'll save that potential deep dive for another time. If you found any value in this video, and I hope you did, please make sure to hit that like button, subscribe, and check out a quote of the day. You might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. And if you're watching at this point in the video, I finally have a little treat for you. We do have a waitlist down below that you can sign up for investor community. We're probably going to open up in a few weeks to a month or so, and hopefully everyone will be able to learn from our mentors in there. We've been doing a lot of beta and pilot and mock sessions, and they've been going really, really well. So I wanted everyone who watches to the end of the video to know about that link because you guys are the real MVPs. Don't forget your peace and thank yous.